When you're just getting started on your investing journey, you'll likely come across the following terms. Here's a quick explanation of some of the important ones that will help you get started investing with more confidence. Stocks. Stocks represent shares of ownership of companies, sometimes also called equity. You can buy shares of publicly traded companies from a stock exchange yourself using InvestorLine Self-Directed or Advice Direct. You could also have an investment representative buy them for you, and you could also own them by buying investment funds like mutual funds and exchange-traded funds. Bonds. Think of a bond as a loan, except the company issuing the bond is the borrower, and the investor is the lender. For example, a company can sell a bond issue for $50 million. This bond might have a 10-year term, meaning that the company will buy back the bond after 10 years and repay the investors. In the meantime, the company will pay interest to the bondholders. Bonds generally tend to be lower risk than stocks, but there can be exceptions. Ticker symbol. If you want to buy shares in a company, you need to know its ticker symbol that identifies it on an exchange. For example, if you wanted to buy BMO shares, you could look up the name of the company in a symbol search. You'll see that the ticker symbol for BMO is conveniently the same, BMO. You'll also see that it trades on more than one exchange. In this case, you can buy the shares on a Canadian stock exchange, denoted by CA, or you can buy it on an American stock exchange, denoted by US. Bid and ask. When you look up the price of a stock, what you are seeing is the price that the most recent trade executed at. But the bid and ask prices represent the highest price someone is willing to pay to buy the stock and the lowest price someone is willing to sell the stock at that precise moment. ETF. ETF stands for Exchange Traded Fund. A fund is an investment that in turn invests in a portfolio of other investments. As an example, a Canadian equity fund could be a fund that purchases a number of different Canadian company stocks. Exchange traded just means that you buy and sell this fund on an exchange, just like an individual stock. Mutual fund. Mutual funds are very similar to ETFs in that they are funds too. Again, funds allow many individual investors to pool their money together into a large fund that is managed according to a specific mandate. However, mutual funds have some differences to ETFs. Traditional mutual funds in Canada have generally been sold through financial advisors or directly to investors without using an exchange. They often don't have commissions to investors to buy them, but they generally have higher ongoing costs than ETFs. MER. MER stands for Management Expense Ratio. With investment funds, whether they are exchange-traded funds or mutual funds, there are ongoing costs to operating a fund. These costs can vary quite a bit. Exchange-traded funds tend to have lower MERs than regular mutual funds. Costs can be as little as a fraction of 1% per year, and they can sometimes be 2% or more per year. Keep in mind that all other things being equal, a higher MER means a lower rate of return. That's why it's important to be mindful of costs, whether they are commissions or MERs. Time horizon. A time horizon is simply the length of time you expect to keep your money invested before you may want it back. Your time horizon is generally tied to a specific goal, such as a down payment on a home, paying for your child's education, or your retirement. But you can also have a general goal of building wealth over a long period of time, too. Risk tolerance. Risk tolerance is very important. Some investments are conservative and some are aggressive. The phrase risk versus return is an important one to understand. Generally, if someone is looking to get higher possible returns, they will have to take on more risk. One major form of risk in investing is the volatility in your investments over time. This is a measure of how much your portfolio might fluctuate in value in the short term. But there are other forms of risk in your portfolio as well. There is the risk that some individual investments will suffer big losses. If you don't have a well-diversified portfolio, for example, you only held a few different stocks, then if any one of those companies went bankrupt, this would create a significant loss for your overall portfolio. That's one reason why diversification is so important. While there are ways to manage risk in your overall portfolio, generally speaking, one of the hardest things to understand about investing is how we will react to risk and losses. If your portfolio has a lot of risk and experiences a big downturn in a short period of time, will you be able to stick to your strategy? Or could you get anxious and sell? If so, then your portfolio's risk may have been higher than your tolerance for risk. It's important to think about how much risk you are willing to accept and to think about creating a portfolio that is in line with your tolerance for risk, your time horizon, and your ability to reach your financial goals. This is hard to know when just getting started and will likely be something you continue to learn over time.